All right, what's up? It's another week, which means it's another What the F happened. So we got TikTok online, we got Instagram online, Facebook, YouTube. We got all the parties that matter right here with us today. Now, this is going to get pretty interesting because there's so much news just today alone. Plus, I've got some white papers to go over about the Biden paying off your college debts and all that and how that whole thing works. So we got an action-packed show, so stay with us. Don't go anywhere. We'll be right back after this. All right. As Matthew McConaughey would say in his book, Green Lights, which Stephen offline told me he's reading, and I've read that book 3 times. It's a really good book about stories of Matthew's life. I want to get into the stories of Wall Street and what's going on in the economy, and that's what we do here on What the F Happened. Today, this show's all about ranting and raving and maybe a little bit of arguing, all about the things that are happening in the world, in the news. And as our audiences join us from around the world, we're going to get right into it because today's an epic day, Stephen. Stephen, today we got some important news coming out from the Fed. Mr. Jerome Powell is going to report on their rate hike. And right here, top line, there we go. There's my cursor. Top line, Federal Reserve to resume rate hikes after the June pause. Now, for many of you that have been paying attention, the Fed paused rates in June, and the markets have rallied ever since, right? The markets have just they haven't gone straight up, folks. Everybody thinks they have. It's been just a line straight across, which we'll show you in a little bit. But, the markets have been going up. We've seen, I think, 14 days, if I'm not mistaken. It was 12 to 14 days of an up market, which is the longest run that we've had of a positive market since, what did I read? 2017, if I'm not mistaken. So again, some of this stuff doesn't just stick in my mind. There's so much data we get, but here's the important thing. The Fed is more than assured that they're going to raise rates 25 basis points. That's exactly what Yahoo Finance says. The Federal Reserve is all but assured to raise interest rates by another 25 basis points this week. And Wall Street doesn't like it. Wall Street wants the Fed to stop raising rates so that they can get back to what their dream is of a soft landing, which is not going to happen. Okay, because the Fed has never been able to pull off a soft landing in history. Does everybody understand what a soft landing is? That's where the Fed's able to kind of take everything and avoid a recession. Now, I don't know, what you're reading, but everything I read says that ain't going to happen. We're not going to see a soft landing. The inverted yield curve shows, and has never been wrong in history, we're not going to see a soft landing. We're going to land in a recession. And one of the other pieces of info that I think is really, really important to understand is this should come as no surprise to Wall Street, but Wall Street is like a whiny child. It's like a 3-year-old child that doesn't get its way. It just cries and cries. Stephen, what are your thoughts about Wall Street and its reaction to the Fed and what the Fed's going to do? We always give Wall Street so much credit that they're always building in data, but Wall Street's always the crying little baby that when it doesn't get its way. And I know we've been playing this whole modern monetary theory. I like to say that's the Fed playing God, trying to make it so that we avoid every recession by creating a bigger bubble that eventually must burst. So what are your thoughts on this, Stephen?
No, I mean, it's, I've been listening to the Green Lights book during the day on runs and doing things like that around the house. But at nighttime, I've been reading the Jekyll from the Creature from Jekyll Island, which I've read pieces of in the past, but I haven't actually read it cover to cover. So I've just been kind of gone back through and just restarted that back up about a week or two ago. And it talks all about, just how banks work and the functions and just how, with all these bank failures, there's like 1,700 of them that had occurred and why it occurred, and basically saying how it's not the banks, it's the system that's failing. And they needed to redo the entire system to prop up the banks. And it's still what we see today. I mean, it's nothing's changed. It's gotten worse. I guess you could say one way or the other, it's either gotten better and better, or it's gotten worse and worse, depending on what side of that fence you fall on. But to me, it's faker and faker. It's more fake money being printed. It's more fake policy being enacted to just continue this house of cards. And, we talked about this a little bit last week, but when you look at the stock market and you see that, we keep hearing it's going up, we see it going across, but we look at those very few stocks that are propping it and keeping it held up. And you look at the underlying parts that are really keeping that market up right now. It's just, if you have 4 columns that are holding up an entire building, basically 3.9% of those columns are crap. And it's the 0.1 that's still holding it up. And as soon as that 0.1 tumbles, we're going to see this entire house of cards fall. And I think that right now, what we're hearing, just like we heard before 2008 happened, just like we heard before the dot-com crash of 2000 happened, we hear these talking heads, we hear these Wall Street analysts and these Wall Street experts, everything's fine, there's no recession, everything's cool. Well, they said the same thing back then too, and then boom, all of a sudden, market crashes, everything hits. Well, we don't know what happened. We can't believe it happened. Oh my God, we gotta bail everybody out. It wasn't our fault. It was blah. And people just, and who gets hurt by that? The people, everyday people like you and me, the middle class, especially. The middle class are the ones that get killed by it. So I think it's criminal. I think it's terrible. And I think it's horrible how much lying goes on. And we see it across the board on everything that's being said right now. It's bizarro world, I feel like.
So let me transition a little bit, because I want to give everybody a history lesson, because some folks on here are young and they didn't live through 2008, nor did they study history enough to understand what happened in 2008. But just let's take you back to 2008. Okay, from 2008 to 2010, we were in what was called the Great Recession. Okay, it was a pretty bad recession, actually. The whole housing market tanked. Everything followed along suit. It was a great buying opportunity in any sector you wanted to buy in. I mean, everything was on sale, but a lot of people were unemployed. People were going bankrupt. Banks were failing. Investment banks were failing, just like now. Okay, but one thing I want you all to remember, when you talk about manipulation and you talk about lies and you talk about who always has to hold the burden, it's us. It's middle class. It's just the tax-paying Americans. Now, what I'm trying to get to is, if you remember that era, Motor City went bankrupt. Does everybody know what Motor City is? It's Detroit. Detroit went bankrupt because they made too many promises on their pensions and all their liabilities and their social programs. And because of that, they couldn't keep up with them. And because they were in trouble, they took risky bets with some of the pension money. And well, we all know the story of how that one worked out. It didn't. It was like $19 billion that the bailout had to happen for Detroit. And you know so what the judge did, and I thought this was pathetic, and I just read a white paper about it the other day, which is why it's top of mind. The judge that was, dealing with Detroit's bankruptcy. Now, remember, folks, this isn't just some individual. And folks, just so you all know, this is Lazy Cash. He finally decided to join us for the party. This is our shop cat. So when Detroit was going through the bankruptcy, the judge ruled that Detroit issued bonds that were not legal. And that's how they were supporting the pension payments. They were issuing bonds, which many municipalities do that. Okay, you can buy bonds from a municipality, any municipality. But they were doing it illegally, says the judge. So when they made that ruling, what happened is, the pensions, okay, and all the recipients of the pensions, they didn't see any change in theirs. And now that was unsecured. So just so you all know, pension funds are unsecured. There's no promise that your pension payments are going to be paid. Just ask ask my dad, ask, my dad's wife, anybody that worked at Harrison's or now known as Delphi. It's a radiator plant that makes radiators for all the car companies in the right in Lockport. Back during this period of time, all those pensions had to be redone. There was bargaining and negotiating with the unions. They had to redo all those pensions, and most people got less money. But in Detroit, the pensions, okay, the recipients of the pensions saw nothing change. But you know who took the weight? All of your parents, your grandparents who bought bonds, municipal bonds from Detroit, you got about 10 cents on the dollar back for those bonds. So again, it always hurts somebody when this happens. But the other sick thing about that is, although that happened back then, the problem hasn't been fixed today. Hasn't been fixed at all. They're still running a deficit. They still don't have enough money. They've got a sinking fund, if you will, where they've got, I can't remember what the amount is, a couple $100 million sitting in this, but by the amounts of the payments that have to be made on these social programs, these pensions, they'll be broke again. So round and round we go. Who's the one that carries the weight? All of you do. The same shit is happening today. The exact same stuff is happening right now. You're just not seeing it yet because you're not looking for it. And I understand, this guy, Scott Duffy, he tells a story every time he speaks about his daughter and how his daughter focuses her attention on finding money, and she always finds money. Have any of you ever done that? Stephen, you ever do that? You ever change your focus to focus intently on one specific thing, and then all of a sudden that you always find that one thing? How many 100%. Of you have done that? Yep. Cat's name is Cash. We call him Lazy Cash. So Scott Duffy's daughter, who was just a little girl, focused on finding money, and she always found money. Everywhere they went, she would find quarters and nickels and dimes and pennies and sometimes dollars and tens. Because what you focus on is what you get. And that's exactly true. See, we just happen to focus on money and the economy and economics. Now, all of you are focused on different things. Maybe on the weekends it's sports. Maybe, during the week it's sports. Who knows? Your focus isn't on the same thing as us. So we're bringing you this. We're reading through the fine, details in the news and bringing you the truth. Now, somebody over here on TikTok just mentioned Ohio. Now, I read something right here. In Ohio, Delphi Packard still hasn't paid salary employees pension benefits. So there you go. So why is it that Delphi didn't get their pension benefits, but yet Detroit, Motor City, all those people got their payments, at least so far? I don't want to count them out yet because, it's not a sure thing. Oh, and then we've got Monty Island saying, just another scammer selling whole life insurance. Sad to see. Monty, grow up, dude. Grow up. You know what? I'll sick my cat on Monty Island because, there's always haters on here, but we love our haters. So, Monty, I'll save you a hug, buddy, okay? We're not selling life insurance today. We're talking about the freaking news. He doesn't even know what show he's on. He's obviously delusional, or maybe he's drunk. Who knows? So let's kind of move on to another thing. So we already talked a little bit about the Fed. So I want to transition back into this. Now, this is the lies that you're being told right here. Since the June meeting, with another month of data to evaluate lending conditions, I am more than confident that the banking turmoil is not going to result in a significant problem for the economy. I hope you are all listening to that and finding the sarcasm in that. And I see no reason why the first two hikes should not occur at our meetings later this month. Now, that's Fed Governor Chris Waller saying that on July 13th. And Powell also recently made a case for more rate hikes based on the latest economic data. If you look at the data over the last quarter, what you see is stronger than expected growth. Okay, hold on. Let's count that one. Stephen, write these down. Stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. Powell said during his panel discussion in Portugal at the end of June. So that tells us, so he's like, well, that tells us that although policy right now is restrictive, it may not be restrictive enough, and it has not been restricted for long enough. So what does that mean? It means they're going to tighten more. They're going to raise rates more. They're going to unwind the balance sheet more. They're going to suck more money out. They're going to make it harder for all of you to get car loans, business loans, any kind of loan. They're going to make it harder. He just said that. So you all, maybe if you read that, you wouldn't be able to kind of articulate what's being said. It's not very difficult. He's saying, F you, we're not done fucking with you. Excuse my language. But that's what he's saying. We're going to fuck with you. Now, but then right before that, and I read that, purposeful. Okay. Chris Waller said, oh, we don't see any significant problems for the economy. Oh, yeah. Silicon Valley Bank, Republic, all those banks that went belly up. No big deal, right? No banking turmoil. And Stephen, you mentioned there's a whole bunch of other banks that have come out, but they've been all kind of hushed. It's all just being pushed off. The Fed's got some things to keep. It's almost like life support, right? Some people, should have been gone a long time ago, but life support keeps them alive. Now, whether that's good, bad, or indifferent, that's a matter of opinion. But the Fed has lots of banks on life support. And some people would say, pull the plug, but not people with deposits in those banks over $250,000. But how many of you understand when you go into a bank and you read the little sign, FDIC, deposits guaranteed up to $250,000? How many of you understand that, right? You understand that if I put more than $250,000 into this bank account, it is no longer guaranteed by the FDIC. I mean, what's so difficult about that? But yet when when Silicon Valley Bank went belly up and it had all the billionaires or all the tech moguls, some of those people were, they were policymakers, they were lobbyists, there was all sorts of people there, influential people. Did any of them that had millions of dollars at Silicon Valley Bank have any kind of a loss? Nope. But it says right on the placket, if you have over $250,000, it's not guaranteed, right? Is that difficult? Am I wrong in thinking that? But the Fed just bailed them out. But how many times can the Fed bail banks out? They can't. But they can keep banks on life support. That's exactly what's happening. But I want to come back to what Waller says. And he said, there's no problem, no significant problem for the economy. Do you realize that's the same guy that said there was no problem with inflation? It's transitory. Do you realize that that's the same guy that said there was no issues with the banking industry, yet then banks went bankrupt? Like, are you seeing the picture here? That's right. Okay. JRez 492 said government equals lies. I hope you're all seeing this because I just read it to you. And then Powell saying, yes, there's tighter than expected labor markets. So a lot of people are employed. The unemployment numbers are going up, though. And then higher than expected inflation. Yes, the Fed wants inflation at 2%. We're definitely above that and having a hard time controlling it. But he did say that higher than expected growth. Stephen, can I just have you explain the overall markets, the S&P 500 and the Dow, and why we think that there's higher than expected growth that is all concentrated in 7 companies out of 500 in the S&P 500. Do you want to hit on that real quick?
Yeah, I mean, we can pull it out. I mean, the why, I guess, is a good question. I mean, it's all the tech companies. And so a lot of it is based around the AI technology that's coming out. But I don't fully understand how these huge funds pick these stocks that they want to go into, like why Facebook is worth what it's worth. I mean, when you look at the multiples of what these companies make versus what the valuations are, oftentimes they're so extended compared to where they really should be. And it's just, I guess when there's constant money just constantly being poured into these markets, into these companies, it has to go somewhere, and it just keeps them going up and up and up. But it is a good question, Chris. Why, the 7 companies have accounted for, 93% of the gains this year, like in the S&P 500, for instance. I mean, you track stocks a lot closer than I do. Maybe you can get into that a little bit more, but it's pretty wild to see.
Well, I mean, it's not difficult. I mean, if you look at the S&P 500 or the Dow Jones, and Stable Lunatic said, I'm submoronic. Great. So,
and the 7 companies, Chris, just Apple, Microsoft, NVIDIA, Google, Tesla, Meta, and Amazon.
Perfect. So all those companies are carrying the entire S&P 500. I just want you to think about that for a second. It's kind of like back during the pandemic, you had FANG. Remember FAANG? We talked about that a lot during that period of time. Those stocks are the reigning, winners in the thing. Well, nothing's really changed. Sure, some of the names have changed a little bit, but it's still the same companies driving the entire market. So you're literally, instead of like looking at 500 companies, you're literally looking at 7, and it's right here. And you can kind of see it. Now, I know TikTok and Instagram can't see this, but what Stephen's showing is the entire S&P 500, and he's breaking it down into sectors. But then he's showing you in each sector, there's literally 1 or maybe 2 companies carrying that entire sector. And that sector is a lot. Go ahead.
Tesla covers 54% of the U.S. EV market in 2023, falling from 72% a year earlier. But it just shows you how big these companies are. I mean, there's, you look at Tesla, and it's, a relatively new company compared to like Ford and GM and the big guys out there. And it's just amazing how strong of a company stock it really has been. Continues to be.
It's crazy to look at communication services. Alphabet dominates that sector. Meta is a small little piece of that as well. And then the pharmaceuticals, you guys could all figure out who that is. Energy is dominated by Chevron and ExxonMobil. So there's literally 7 companies, and it's a drastic difference, that are carrying the entire S&P 500. And those 7 companies, go ahead.
Sorry, chipmaker NVIDIA is worth nearly as much as the entire real estate sector combined, which is down here. So, I mean,
it's crazy.
there's just so much wrong with that, in my opinion.
Well, because I mean, how many of you have heard that, that diversification is important? Now, diversification is important, but a lot of people don't understand diversification. I was working with a client the other day. She's got, a couple $1,000,000, and Schwab is where she just rolled over her pension. And she said, she told me on the phone, she says, it's really conservative. And I said, okay, well, let's just do a call and let's go through the positions just so I can make sure that it's conservative. Just by them telling you it's conservative doesn't mean it is. When she gave me her portfolio, I was floored. Now, this is a financial advisor that made this recommendation to her and put her in this portfolio. She knows nothing about stocks. She just knows, I'm conservative. I don't want to lose money. I just retired. I can't afford to have this money go down at all. Listen to me, folks, because if any of you work with an advisor, you need to pay attention, because this is happening across the board on most advisors. They're just not listening to clients' needs and goals and risk profiles. When I went through this portfolio, she had heavy concentration in large cap stocks. She had heavy concentration in REITs. She had heavy concentration in small cap stocks and international growth stocks. Now, I know some of you may not understand that, but all I can say is if you're looking at a risk profile from conservative to highest risk, she's like right over there in high risk. And the only things she had in there that were, I think, suitable was she had a small cash position, very small in relation to the amount she had. She also had a 5 to 10 year corporate bond position, which was, I guess, suitable. And then she had only one intermediate treasury bond position, and it was an ETF. And the funny thing is now, remember, this was a Schwab advisor she worked with. How many of those holdings do you think were any other ETF or mutual fund than Schwab? And there was a whole bunch of them. One other position was not a Schwab. That's it. So when we talk about diversification, it doesn't mean just the number of holdings you have in your portfolio. And it doesn't mean that you've got a variant of small, mid, large cap, which that helps. But when you talk about diversification, it's diversification as Ray Dalio teaches it. Diversification. Oh, sorry, my phone's ringing here, which was weird. Diversification of asset classes, folks. That's what matters. Not diversification among mutual funds, diversification among ETFs, diversification of stocks. Like, those are important, but it's asset classes you got to pay attention to. And that's where people make the mistake. And when we come over here and I look at this next article, and this is really important. So remember, just a second ago, we had we had Chris Warren, and we also have, and I'm sorry, Wallace, or Warren Wallace, whatever. And then we also had Jerome Powell, okay, both telling you nothing to see over here, nothing happening. We don't have any issues. But then when you come over here, one article down in Yahoo Finance, Bloomberg says deep recession to force full percentage point Fed cut, double line warrants. Okay, so what this is going through, this is a whole article talking about everything that Stephen and I have been talking about on the Wealth webinar. And folks, if any of you want to learn more about this, it's funny, Tweety. My cousin is a financial advisor. I don't trust anyone else. Okay, good. Make sure your cousin has your best interest in mind, which I'm sure they do. But when you're, sorry, I got off track by reading that quote. Yes, I was mentioning, when you want to learn more, join us every Wednesday at 1 p.m. Eastern for the Wealth webinar. And you can register by going to chrisnaugle.com. It's a free registration. Okay. And you join us at 1 p.m. Eastern, and we go deeper into this. So you got one side here saying there's nothing to see, no problem. Okay. We're going to soft land, basically, is what the Fed and, what the Fed is essentially saying. But then over here, one article down, you got Bloomberg saying it's not going to be the case. We're going to be in a recession. And because we're going to be in a recession, they're going to pull interest rates. Now, let me just give you a little lesson. And this would make a bunch of you money if you actually listen. But Tweety's got a cousin who probably, isn't doing this for Tweety. If you just know some basic facts, and some basic facts we know to be 100% true, is that the Fed has been raising interest rates. We all can agree with that, right? You don't need to like me. You don't need to like Stephen. As a matter of fact, you can hate me, but you can agree the Fed has been raising interest rates 10 times, and soon to be, today will be 11 times, and then next month will probably be 12 times, right? 12 times in just a little over a year. That's a fact. And the other fact that all advisors know, including Tweety's cousin, should know, because if they got their Series 7 like I had for many, many, many years until I sold my practice and retired from Wall Street, all of them know that when interest rates go up, bond prices go down. It's just an X. Interest rates go up. We know that to be fact. And we also know the fact is the inverse relationship to bonds, specifically long-term treasury bonds, the things that banks and countries buy because they're guaranteed by the full faith and credit of the United States government. So if price comes down on bonds, what would you want to buy? Would you want to buy large cap stocks, which are at all-time highs, just crossed the 52-week high? Would you want to buy small cap stocks, which are also crossing 52-week highs? Do you want to buy international stocks, which are also at all-time highs? Do you want to buy high? Or would you prefer to buy low? You'd want to buy low, right? Because Warren Buffett said to make money investing, you buy low, you sell high. So yesterday, when I talked to that client, like after my conversation, she decided to sell the high, okay, which is smart. She said, I'm going to sell all these ones that are high because I've got gains here. And I'm going to buy deeper into the ones that are low. It made perfect logical sense. She's not even an investor like that knows much about it, but she understood buy low, sell high. How many of you understand that, right? Tweety said buy low, right? It's what you do. It's not very complicated. That's right. Lynn Schwab bought Ameritrade, but still the merger still hasn't fully come together, which is why you can still have a TD Ameritrade account and still have a Schwab account. But yes, they are merging. So if you really want to make headwinds or headways or whatever, you want to make a good decision here, buy low. And right now, factually, 100%, you can buy treasury bonds low. You could even buy, corporate bonds. Some of them are low because when interest rates go up, the price goes down. But if you then read this article, and I just want to test your knowledge here, deep recession to force full percentage point Fed cut. Now, the Fed said they're raising rates, but if we go into a recession, the Fed will cut rates, which is what Bloomberg's saying in this article. And that is a fact too. If you look at any other recessionary period in history, every one of them, the Fed's action, first and foremost, has been to cut rates. Remember back during the pandemic, they cut rates to almost zero. Remember back during the Great Recession? Yep, they cut rates. Remember the dot-com crash? Yep, they cut rates. Same thing in the 90s and 80s and 70s and 60s. And we could go all the way back to the Great Depression. Always, 100% of the time, the Fed drops rates. Bloomberg is telling you that that's what they're probably going to do. Deep recession to force full percentage point cut. So if we know that the price goes down when rates go up, but what happens when rates go down? Well, the price of your bonds goes up. So you bought the bonds low because you bought when rates were going up. And when we get into a recession, which we already are, but when we go deeper into the recession, the Fed right here will drop interest rates because they always do. It's what they always do. It's a knee-jerk reaction. They always drop interest rates to make money cheap and make people want to spend money to stimulate the economy and get us out of the recession. The opposite of what they're trying to do right now is stunt the economy by raising rates. So when that happens, you make money in treasury bonds. You make money in bonds because of the inverse relationship. I love this. So somebody's been around our campfire or somebody's, been really studying. Jules over here on Twitter said TLT. I own a ton of TLT. I'm not making a recommendation or a suggestion. It's just what I own in my portfolio. I own a lot of TLT and then several other ETFs, which are directly buying and holding 20 plus year treasury bonds. I like 30 year, not because I'm going to hold them for 30 years, but because the longer the duration of the bond, the bigger the price movement is with interest rates. It's quite simple. And Jules just hit on that TLT. It's a very, and then someone just said hasn't happened yet. So some of you, like this person, and I don't know what they're saying. It's RG, I can't read it, 0411, said hasn't happened yet. Some of you are going to wait until it happens. And guess what? You missed the entire opportunity. You missed the entire opportunity. If you're the type of person that has to wait until it happens, you are the type of person that is always chasing the winners and you're always the loser. I don't mean to say that. I'm not insinuating that person's a loser, but I'm simply telling them that this is one of the problems. Everybody waits for something to happen before they make the changes. Everybody waits for the market to crash before they want to sell when they should be selling high, not low. But most people buy high because most people right now are doing what the market tells them to do. The markets look like they're going up, which they're really not. So they buy. And then when the markets go down, what do? They sell. So what are they doing? The opposite of what they should do to make money, which is why the majority of investors lose money in the stock market because they simply follow the wrong thing. They're following their emotion. They're making emotional based decisions, which never ends well. You got to make logical decisions based on fundamentals like Warren Buffett does, decisions based on actual fact. These are the things you need to be doing. And these are the things that most people do not do. Are you one of those that does or does not? So Stephen, let's get into some of the questions here. What do we got over here on you?
Just a lot of people kind of agreeing. I can find a couple. Anything coming in over on the other side?
Oh, there's always stuff coming over here. Different people asking. I'm talking about interest rates. Oh, okay, hasn't happened, right. But RGO 411. I'm telling you, it's going to happen, and Bloomberg is doubling down and telling you also that it's going to happen. So, when you said hasn't happened yet, you're right. Interest rates haven't gone down yet because we're not deep enough into a recession. The Fed's actually still working on taming inflation, so they haven't dropped interest rates, but they will. Is what I'm trying to tell you is you can't wait for it to happen to act because then it's too late. When the Fed drops interest rates, the bond prices go up. If you buy the bonds, then it's you already missed a huge opportunity. So I hope you understand that, and I hope that makes sense. And I appreciate you joining us for this. Looking for a house. So you're new here and you're looking for a house. Awesome. Well, just know, based on being new here, that the Fed is going to raise rates again. And we're probably going to see another 0.25% interest rate hike, which means your house just got more expensive because you're going to pay more in interest. But one thing that I think is interesting, and you'll have to join us, I think it's August 24th, but wealth webinar we do every single Wednesday. Stephen and I host a free webinar for each and every single one of you where we go deep into these topics. We've got an expert coming on that is going to talk to you a lot about mortgages and how they work, the untold truth about mortgages and inflation adjusted cost of a mortgage. And it'll be really interesting for someone like that that's looking to buy a house. So let's see. Here's a good one, Stephen. Did you skip school all the time and then become a Glenn Beck expert? Oh, yeah. So I skipped school all the time. I never went to high school. I never went to college. I just skipped it all. And Glenn Beck. Yeah, I became a Glenn. I don't even know. I know who Glenn is. I don't watch Glenn stuff. So thanks for the comment. Hater, you can troll on or you can stay here and I'll save a hug for my haters. Okay. That's all I got over on this side, Stephen.
Yeah. So
a couple good comments coming in, but not as good as last week. Last week we had so many good comments coming in from TikTok. Today we got a whole bunch of people that just think they know what they don't know. What's up, buddy?
We talk about treasury bonds. People don't argue too much.
Yeah, and Shauna did ask a good question coming in on YouTube. Shauna asked if me and you actually planned our outfits today because kind of strange, but we are each wearing the BYOB, it's kind of like I don't know if you call it a tie-dye, but whatever this shirt is. But we did mix up the colors, Shauna. We mixed up the colors. You got a yellow one, I got a blue one.
Oh, she's saying, are we bringing them? Are you packing those shirts for Raleigh? Oh, are we going to wear them together in Raleigh too? Yes.
I'll be, so if anybody, we got
if anybody's in the Carolina area, we have a live event called Money Tank that we put on where we bring together a bunch of real estate entrepreneurs and a bunch of people with money and stick them in the same room together for a couple of days and provide a lot of education on how to put deals together and how to save on paying taxes and things of that nature. So come out and see us if you're in the Raleigh, North Carolina area next weekend, August 4th and 5th, or join us next Tuesday evening. We're going to do something cool if you want to join us virtually, where you can maybe get a shirt just like this. I don't know, maybe free of charge. So join us next Tuesday for a little special we got going.
Love it. I love it. I do want to hit one question over here. It said, let's see. Whoops, I lost it. So I'm just dropping in. What about silver? It's low now. No, silver is not low right now. Silver will probably see a little bit more of an increase, but you got to be careful with gold and silver right now. It's funny. I just read a whole article on this. I should have brought that one in. So typically silver and gold is it's a recessionary, or it's a defensive position against a falling market. But you got to get into silver and gold at the right time, and it's kind of depends on how you look at it. Is silver low? Silver's always low because silver's going to continue to go up, but it is going to fluctuate, and there's a right time and a wrong time. So I think right now silver and gold are relatively high in terms of price because there's a lot of fear in the markets, which insinuates people buy silver and gold. I mean, Stephen, you're more of an expert on silver and gold than I am. So do you want to hit on that one right now? Do you think silver's low, or do you think it's high, or do you think it doesn't matter?
No, I think it doesn't really matter. I think it's always a good thing to kind of dollar cost average into it. In my opinion, it's one of those things you don't put a whole lot of money into it, but you buy it regularly. And I think in the long run, it's not going to hurt. It doesn't hurt to have silver and gold, especially physical. Like I like to keep it here. I like to keep it in a safe location. not necessarily here, but in a safe location that's easily accessible to me. And I just think it's not a bad thing. But I believe that about guns. I think, I think collecting guns, it never hurt anybody, and ammunition. So things like that, though, are just something kind of on the side, not really an active investing strategy, or something to throw some extra dollars at here and there and then see what happens long term. And that's what I've been doing for a couple of years. Yeah, Lisa said 7K. So that's the company I buy from. It's called 7K Metals. And one of these days when we decide to add a 9th weekly webinar, maybe I'll start doing a gold and silver one again. So we'll see as time allows.
We do 9 free.
Not every week, but we do 5 to 8 every week.
5 to 8 free webinars every single week for all of you. But yet still the haters hate hearing from us and say that I didn't go to school. That's fine. This is a really good question that somebody said. Somebody said on TikTok, and it's RGO411, would you rent or buy a house right now? I think it's a really difficult question to answer. And I think there's 2 answers. I mean, both are right. If you're looking for your forever home, buying a home right now is not such a bad thing. You're not going to get a good deal. You're going to pay probably at the higher end of the spectrum for the home. But if it's the right home, why would you not buy it? If you've got a family and you want a home and that's what you want to provide for your family, then why not, right? Just understand, if you buy a home right now, chances of you selling it and making money in the next 5 to 10 years is going to be much lower than what it was in the prior cycle. So I don't know. I mean, renting is expensive. Renting is probably more expensive because you're just giving money away every month. But you can use renting as a bridge to kind of bridge through this period of time. If you really truly believe price of housing is going to come down, which I do. Me and Stephen maybe differ a little bit about this. I think the price of housing is going to come down because as the Fed raises interest rates, it makes it so expensive to buy. Plus the pricing is so high because there's so much demand. And a lot of people just keep saying demand, demand, demand. The market's the stock or the real estate market's not going to go down because there's so much demand. But demand is only good if demand can afford the housing stock, which right now you're at a breaking point. And the Fed raising rates again and maybe a couple more times the rest of this year, you're going to break the back of that. And here's the thing, like, I hate to say this, but that's by design. They don't want you to buy houses. They're making it very difficult. Have any of you tried getting a mortgage for a house recently? Because I'm selling a couple of our rentals, and the people that are buying them are struggling to get mortgages. Now, maybe they're not the best A paper for the bank, but they're people that a year, 2 years, 3 years ago could have got a mortgage like that. Now they're struggling because the banks have tightened. And I know if any of you have tried getting a car loan, they're tightening on car loans, boat loans, tightening. Everything's getting harder, and that's by design, folks. So go ahead.
Yeah, I was just having this discussion with my dad actually here recently. He has a rental property he was talking about doing owner financing for, just to kind of get it off his hands, put the responsibility on, the buyer, and helping somebody out that couldn't qualify. When I was in high school, my dad had a buy here, pay here car dealership. And so I kind of grew up working for him in high school, and I'd go to auctions, but he would sell cars at 29.9% interest. And the funny thing with that, though, is he would charge the 29.9 because the people had no other options. They couldn't get financing from the bank, bad credit, no credit check, that kind of thing. But we actually would run specials where we would say, okay, for this weekend only, or for the next month, in the month of June, 0%, no interest. And guess what, Chris? It made no difference. And that's kind of like at an early age. Like, I look back on that now, and it's like amazing how many people don't understand money. Like, bleeding 29%, bleeding even 10% a month out in interest, or annually in interest to banks, just how much that bleeds your wealth and how much it hinders your ability to be financially successful, which is why I absolutely fell in love in 2020 during COVID with infinite banking concept and becoming your own bank, because it solves that problem and you're not bleeding all that money out. But back to my original story of my dad's car dealership is, so he's kind of had that idea for a long time of being able to help other people that otherwise couldn't get what they wanted and go ahead and finance it for them. And he's done it in the past with other property. But I was talking to him about this property specifically because he bought the house years ago, so it's appreciated quite a bit. It's over in the Fort Myers area in Southwest Florida, which is a very appreciated market. Once again, it was one of the highest in the country, and with one of the highest crashes in 2008. But it seems like that's happening again right now. Some of the reports you read last week, Chris, named Fort Myers again as one of the areas they're expecting to crash. So I told him, I said, listen, if you own or finance this thing, you think that you're pushing off the risk, but really you're assuming the risk, because if that market does drop and those people can't afford the house, yeah, you're going to be able to take it back because you hold the paper on it. But if that property drops 40% in a housing pullback, you're actually losing money because, and I said, so I told him, I said, if you decide to do this, you need to at least get a down payment, what you expect that property to possibly drop. So then if he gets, let's say 30% down, we have a 30% drop in the market, at least he gets his money there up front, where if he needs to sell it, then he's not losing money. So little things like that. But I agree, Chris. I mean, I think the market's going to pull back. I was looking at some different things just now talking about the housing market, and housing prices, I'll just read a couple articles from CNBC yesterday. Home prices continue to climb with striking regional differences. So kind of different areas of the country are seeing prices increase. Some are seeing slight decreases, but the market's staying pretty strong right now, even with these high interest rates. But why is that happening? Well, people are not selling. So if you sell your home, you have to move somewhere else. And people realize that the market's high and they're not going to give up those 2 and 3% interest rates to sell and then get into a 7 or 8% interest rate. It just doesn't make sense, even though they're making money on the first house, buying high on the second house. So they're not selling. So that's one of the reasons inventory is still so low, is just nobody's moving. Nobody's willing to do that right now. And that low lack of inventory is what's keeping those prices high. But at some point that can't maintain. Like, something has to break. And so we see the Federal Reserve today at 2 p.m. They're expected to increase rates by a quarter point, by 25 basis points, from 5.25 to 5.5. Well, anytime there's a rate increase, it increases all the rates. So the banks increase their mortgage rates, the credit card rates. So if we look at current rates right now, and this just goes into like how people are spending and what's going to happen. So if we look at HELOCs, so Chris, we talk a lot about HELOCs over the last 3 or 4 years. So what were we teaching people last year about HELOCs? We were teaching them to go ahead, tap into all that equity in the house. Let's say they could borrow the money at 3% from the bank on that equity, lend it out at, let's say, 12%, and make that nice 9% spread. Well, right now, the current HELOC rate in this country, and I'll just share this chart because it's pretty interesting to see it. And I'll get into credit cards in just a second. Sorry, I have like 50 things pulled up right now. Okay, here we go. So this was just as of just recently here last week. So your average HELOC rate right now is 8.5%, 8.58%, with them ranging all the way up to 9.5%. So let's just do easy numbers, 9%. So that same 12% private money loan using equity, you're only making 3%. So when you look at the risk associated with only making a 3% spread, a lot of times it's not worth it. And so a lot of people, when you see anything like this, are putting that money towards a business, or even using a HELOC to fix up your house, where you're taking that money and you're putting it back into the economy, into construction companies and carpenters and people to do the work and the manufacturing. So as these rates increase and people stop spending money, it halts the economy and it slows everything down. So if we know all of this is happening, it's been happening, more and more over the last year. Well, what's holding this market still up? Like we mentioned a second ago. Well, if we look at what the Fed has done, so this is the Federal Reserve assets on the Federal Reserve books. Look at this. I mean, they haven't came down much. I mean, this was going into COVID. Everybody knows they printed and spent trillions and trillions, $9 trillion. And you can see it just slowly continue to creep up through COVID. And then they started to pull back a little bit this last year. But as the market tanked, they had to say to reverse that, and they're slowly pulling back. But when you look at this pullback in relation to what they've done, in relation to where they should have gone, like what happens when they really do start selling off the books and start reducing these assets? And again, this cannot maintain, especially with rates where they are. The debt is becoming, there's no way we can service the debt anymore. There's no way we can pay this debt. It's becoming so high. It's passing GDP and everything else. So it's just like all this stuff is happening, but then you have these talking heads, like we open the show and say, everything's fine, everything's good. It's just the numbers don't add up, Chris. It's just crazy.
Yeah, we got a bunch of comments coming in here for Instagram. Somebody bought their house for like 127. It's Liberty Rebel 91 bought their house. I think it's 127 was what it said. They sold it for over 200, mid 200s, and they just couldn't find a house, so they actually built a house for their growing family. They rolled most of the equity from their starter home into the house that they built. So again, there's never a bad time to buy your family's house, and a lot of people are like, should I rent or should I buy? It's really circumstantial. It's really one of those things. It's just, if you buy or build, you have to understand that that's definitely the price you buy or build at today. You very well might not get that same price for 5 to 10 years. You're going to have a deflationary period, and then it'll inflate again. I mean, these are just cycles. They're just economic cycles.
Yeah, I mean, depreciation, just like appreciation on a home, is the same thing. Like appreciation, you buy a house for 300 grand, it's worth 600 grand. Unless you do tap into a HELOC, that equity's pointless. And really it's a negative because it increases your property taxes and increases your insurance. So your overall cost of owning that home is actually higher as the property appreciates. Where on the flip side of that, depreciation, same thing. You buy a house for 300 grand, or now you buy the house at 600 grand, it drops back down to 300 grand. Well, now you're negative 300 in that property. Who cares? If you're not selling it, if you're living in that home to live in it, like, what does that matter? What it's worth at that point? It doesn't matter. So yeah, if you're going to live there, like, who cares? And so you just, at that point, you just compare, well, how much is rent versus how much my mortgage would be. And then just know that rents typically do not go down, even in a housing pullback, and even in a recession. Rents often, especially affordable housing, maybe not luxury homes, but affordable middle-class housing, rents typically stay the same. They don't really fluctuate too much down. And so that rent might be the same, where that home you're buying today at a 7% interest rate, well, if the rates do drop, you can always refinance the thing and actually drop your payment. So if you're saving on a mortgage right now versus rent, you maybe even save significantly more in the future when rates drop. So it does make sense, in my opinion, if it's a home you're living in and you have no problem living there for the next decade, then why not buy right now?
I completely agree. And it's kind of funny on TikTok and over here on YouTube, we've got two people talking about the same thing. RGO411 on TikTok, and we got kind of a couple of people, Michael and Ocean 888 over here on YouTube, are talking about rent to owns. Now, I've done not rent to owns, but lease with options. We've done several of those. And here's the first thing: if you do any research, RGO, on rent to owns, I think the percentage is like, in Michael or Ocean, you might know this, but I think it's over 90% of all rent to owns never materialize. So most rent to owns, you have to put a deposit down, a non-refundable deposit, in order to do that. And 90% of the people that want to do a rent to own do not actually end up owning the house because they can't financially get there. You see, once a person has credit issues or financial issues, it's very difficult for that person to get on the right track. Not impossible, but difficult. And, statistics show that 90% of all rent to owns don't materialize. I firsthand can tell you that. We have one right now. So I had one work back in like 2016, a lease with an option they did buy. I've had 3 not work, and I have one right now that might materialize, but they're having difficulty getting a mortgage because, again, there's a reason they're renting and doing a rent to own versus doing, just owning the house. We would have sold them the house anytime they wanted it, but they just can't do it for obvious reasons. So I think also Michael made a thing. I think rent to own has always been a rare opportunity. IMO, it will always be an option that appears, but you have to jump on them in real estate. So RGO over here on TikTok, you're probably not going to find many rent to owns right now. I'm not saying you can't, but you're probably going to have a hard time. Joanna Hurst said, somebody's trying to join. Joanna said, buy a $300,000 home at 7.5, wait for the rates to drop, and then refinance, boom, when the value goes up. But again, just understand, Joanna's right there, and so is Stephen, like saying the same thing. But what you got to understand is that could be a 10-year period of time. But if you buy a house at 7.5, I mean, you're still, whether you buy a house at 3% or 7.5, the only difference is the monthly payment. You're still giving the bank most of the interest upfront in the first 7 years. So if you get to 10 years, chances are the housing will be back, maybe sooner, hopefully sooner, and you'll be able to refinance out at a lower rate. These are the cycles. So just ride the cycles if you want to buy a house. I want to come over here because we got really deep down that housing thing. I want to come over here and I want to talk about another article in Yahoo Finance. And folks, write this name down or try to remember this. John Huesman Okay, it's HUSSMAN. He's pretty well known in the circles, in the market cycles, of being able to kind of predict what's going on because he's been in the game. And there's lots of people like that. Ray Dalio is throwing up warning signs left, right, and center about what's about to happen. And then you got all sorts of them. But this gentleman here is also one. And here's what he says. And this is in Yahoo Finance. You can look it up. A long-term market bear who called the 2000 and 2008 crashes warns the S&P 500 could plummet 64%, bursting a historic bubble. What that person said, some of you would think, oh, that's doom and gloom. It's not, because that's not the only person saying it. They're saying it. Another guy, Rodney, another economist, is saying that. Our white papers from our family offices, the economist over at the family office is saying the same thing. Harry Dent Jr., love him or hate him, is saying the same thing. You know, so like, how can all of these people see the same thing, but the average public doesn't? It's because you're being led by a house of cards. We showed you the house of cards. You just got to listen. Like, it's right here in the news. Then there's stuff about Epstein. This could be the Fed's last rate hike. Is it time to buy bonds? Holy crap. Right here. Okay. This is a Barron's article. This could be the Fed's last rate hike. Is it time to buy bonds? Why would the article say that? I already explained it. And I actually drew it for somebody. There it is. It's an X. When interest rates go up, I know it's backwards, but when interest rates go up, the price of bonds goes down. You should be buying bonds, treasury bonds specifically. The longer duration, the better, because of bigger price fluctuation. Because right there, this could be the Fed's last rate hike, basically saying they're going to hopefully pause rate hikes after a couple more, which means then they'll let the markets do what they got to do, get inflation back, and eventually rates are going to go back down the other side. It's not going to be, it probably won't be next year, but it could be. So again, don't wait for this. Get ahead of this. Be proactive, not reactive. That's the single most important thing. Proactive, not reactive. Reactive investors always lose. Those are the ones that sell low. And then people like me who are proactive buy low. They're selling low, losing money. I'm buying low, making money. Which side do you want to be on? It's not complicated. Let's see. I just want to come over here to YouTube.
Hey, Chris, what you said earlier about the 12th consecutive positive day in the markets. Well, the Dow, this was as of Monday, but the Dow just ended its 11th consecutive day. It was the 6th time since 1945 that the Dow had such a long winning streak. So very, very rare. And if you play by the buy low, sell high, might be a good time to maybe sell high, maybe.
This is kind of old news, but new news never gets old talking about it. Hunter Biden set to plead guilty on criminal tax charges. I mean, the dude should be behind bars, but whatever. I mean, did any of you buy his paintings? Or is that just like undisclosed people that paid millions of dollars for Hunter Biden's paintings? Did anyone on here, seriously, like, did anyone buy Hunter Biden's paintings? I mean, I don't know. Maybe that's your investment strategy. I mean, maybe it'll be worth money. Who knows? People invest in the strangest things. And Rhino over here said, dude, who cares? Dude, why are you even here? Go somewhere. Anyway, over here, back to Facebook, it says, Mike Sealy said financing on multifamily is the lowest since 2015. A lot of the financing on multifamilies is being done in the syndication realm, which, you know, beware of some syndications. There's a lot of bad ones out there right now. And also being done in the private investing world, the private lending world, which is why we created privatemoneyclub.com, so that they could finance that. Hopefully I'm reading into your question right, Mike. He said market tends to forget that from 1978 to 2004, rates were not at 3%. Yeah, so what Mike is saying here is, you know, I know we're talking about rates being high, but rates really aren't high historically. Rates are actually kind of normal. So historically, if you look at interest rates, like 6-7% is kind of the normal. We just got used to a period of time that will never probably happen again in our lifetimes of historically low interest rates, which is exactly why we're in this circumstance and situation we are in right now. I want to come back over and just because I need to argue a little bit with Mr. Rhino here on TikTok. You think there's people in here who bought those paintings? That's how stupid this person is. Literally, like, that was a joke, idiot. Do I really think there's people that bought those paintings? No. It was a dumb question just to see whose idiot question I could get flushed out. And you won. You won the bet, man. You're the idiot that actually answered the damn question. But Rhino said, who cares, earlier when we were talking about what I think is really important thing if any of you want to make money. But Rhino doesn't have any money because Rhino doesn't care. Rhino's playing video games all day long, drinking, Coca-Cola or doing Mountain Dew or whatever the hell, he's doing. Rhino doesn't care because Rhino's got no money. See, that's what we know. We know when someone doesn't care about the stuff we're talking about, it's because they don't have any money. So Rhino's probably 14 years old and playing video games. Good job, Rhino. And yes, I'm sure you were one of the ones that bought Hunter Biden's paintings. Great job, buddy. Anyway, that's my my argument for the day. And Rhino's going to keep going. Oh, I have 5 houses. Yeah, what? But are they Barbie doll houses? Is that what you got? You got 5 of those Ken houses? How many of you saw the movie Barbie? Because I did. I went this weekend. My wife brought me there, and we got all dressed up and went. I will never, ever again in the rest of my life watch that movie. I will never again have any purpose or reason to go back and see that movie. But I'm glad to say that I actually saw it, and I felt much dumber after I watched it. But there was a couple cool things in the movie, like, Barbie, get back in the box, Barbie, get back in the box. Like, that is a very relatable thing for today's times. The Fed, the government wants you all to get in the box. And Barbie said, nope. She said, before I get in the box, that's what you should be saying. Before I get in the box, I want to do this, this, this. I want to ask this, this, this. You should be questioning things right now. But anyway, Rhino, I'm sure, saw Barbie. So good job, Rhino.
Yeah, Mike just said, look forward to seeing you guys. Mike just said, look forward to seeing you guys in Raleigh. So I was saying earlier, we're going to be in Raleigh next weekend. If anybody doesn't know, you just go over to privatemoneyclub.com/money tank. And we got the event coming up the 4th and 5th. So just hop on over to the page, check it out. Looks like we still got a discount code available for half off general admission. We got a virtual option. It's going to be a lot of fun. So if you haven't got a ticket yet, grab one. We got a few seats left. I expect it to sell out by probably this weekend. So definitely grab a ticket if you haven't already, and we look forward to seeing you guys there. The last thing I'll say, Chris, before we wrap, is I was just looking, as these rates increase, like how that affects regular everyday people. And I saw that, the average, a lot of people start putting stuff on credit cards, as inflation's gone up so high, and it's been harder and harder just to feed a family. So the average credit card rate is 24.52% as of right now. That's crazy, crazy, crazy high. And so if you are looking to be financially smart and kind of, you need some help getting out of any credit card debt, join us at 1:00 today. We usually talk about what's called the infinite banking concept and becoming your own bank, but please reach out to us or go over to the YouTube channel at the Chris Naugle and watch some of the videos we have. Very important, though, to come up with a plan and strategy to get out of that credit card debt, because rates are going to continue to go up. Credit card rates are going to continue to be super high. It's going to continue to be a tough economy for an average middle-class family. So let's be smart about it. Let's work on it. We have strategies that can definitely help you with that, and we would love to help you. So we don't usually pitch on this show, but I just wanted to offer, if anybody's looking for some help because of those crazy rates and everything going on right now, we are here for you. All right.
Love it. And the last thing I want to hit on is this question here from John from MD on TikTok. He said, what about BRICS? The BRICS meeting coming up. So there's a meeting coming that isn't really highly publicized, and it's the meeting of the BRICS, and you all should know what that is. And it's his question is de-dollarization. So there's a lot of talk about the dollar, and is the dollar going to be the reserve currency in the future? And I guess you could really look at this 2 ways. Probably, if you follow Ray Dalio, the answer is probably not. But when will that be? It probably will be a long time, because there is no other currency right now that can rival the dollar. So for the BRICS to come together and put together a currency that could rival the dollar and its usage is going to take probably the better part of a decade, maybe a little less. Like, we're in a digital age, so they probably could. And with the Fed now launching in July and digital dollar coming, whether you like it or not, it's difficult to say what's going to happen to the dollar, but I would say that the dollar itself is the reserve currency, and the dollar represents 60% of all world trade. So all world trade, 60% plus of the world trade is done in the US dollar. So that's not going to just go away. The BRICS aren't going to just create a currency. The yuan's not going to just come in. The yuan is not even in the running, I would say, right now to take over the dollar. But could it be in the future if they got together with the Saudis and like you're talking about BRICS? Could that happen? Yes. Ray Dalio says it's actually, we're on our path there. He says the U.S. is an empire going down, and you can see that happening. We have very weak leadership, and then China is coming up. So eventually you're going to have that convergence. Eventually, like if you follow history, it's going to lead to it's going to land in a war. I think the real question isn't so much de-dollarization, is are we going to end up in a civil war, in the next couple of years? Because we got a big election coming up next year that's going to be highly controversial. That's going to create a lot more. If this country's not already divided, I think this election is going to divide the country even more. And it will be largely due to the media and just this taking sides. And I think that's something I warn all of you, is the media is creating divide in this country. We all need to come together as the land of the free, the Americans. We need to come together as Americans. If there's going to be any hope for this country, any hope for the dollar, it lands with us. It really does. So take that for what it's worth. But the worst thing I think that I could see in my lifetime, outside of a nuclear war or a comet hitting Earth, would be a civil war. Study history and read about the past civil war. It's gruesome. It's awful. It's Americans fighting Americans. And that's not something that I want to live through. So folks, we cannot become any more divided than we are right now. So I urge all of you, I know this show, we kind of joke around and argue a little bit, but at the end of the day, that's why I always say haters need hugs too. We need to come together, and we need to learn how to work together as Americans to support this country and the greatest country on earth, because that's exactly what we are. If you don't believe that, well, then move to another country. And I'd like to give a shout out and take my hat off to all the vets, to all the military men and women who are protecting our freedom and out there doing the unthinkable to make sure that this is the land of the free. Thank you all to vets and everybody else out there putting their best foot forward to provide that freedom that we all enjoy and many of us take for granted. So with that being said, thanks for joining us for another week of Wealth Webinar, another week of What the F Happened. But yes, we do have Wealth Webinar and Ask Me Anything and Money Club Monday and all sorts of other ones. So you can join us for any of our free webinars. But let's start with this afternoon's, which is the Wealth Webinar. You can join us for free, 1 p.m. Eastern. We will see you there. Just go to chrisnaugle.com. Have a good day.